Okay, I guess it's midterm week, so little sparse attendance. Anyway, all good. All right, so we're going to continue to work on modeling tonight. We're going to finish up or some of the basics, and then do funds flow, and then go into forecasting, which separates a good analyst from a great analyst, or a great analyst from a. So if you were modeling Starbucks, how does Starbucks grow revenues? How does Starbucks grow revenues? There's really two ways. You add stores, right? The more stores that you add, the more revenues the company is going to have coming into them. And the second way is you grow same-store sales, right? So you grow same-store sales by adding more menu items, breakfast, maybe lunch, right? You add more drinks to the menu, more stuff on the menu, or you raise price, right? These are really three ways, but same-store sales is a critical variable that retailers use to really measures how relevant is the concept, the store concept. So again, we always start with the quarterly press release. This tells us the metrics that we can potentially use. So here they tell us, oh, global same-store sales increased 8%. This is for the quarter. And then they give us this great data, change in comparable same-store sales. They actually give us ending stores, so we can actually figure out how many stores they added in the quarter and the year. They also give us revenues. And they give us this both North America and international. So now we're like, great, I am in business. This is everything I possibly need to actually, model the company. So here is my Starbucks model. Actually caught a couple errors, but this is new. But anyway, it's historical is in good shape. So now we can take, right, we always try to break things down into units and price. Beginning stores, store added, ending stores, and then they give us revenues by North America and international. So we actually can compute what is the revenue per store, right, for North America, right, which we have here. And we could do the same thing internationally, right? Beginning store, store added, ending store, and revenue per store. And so this really highlights and so you could take the lazy person's approach and just do a consolidated model. But if they give you the data, break it down, and this really tells you why. International is where all the growth is, right? Here they added, in 2023, 1,800 stores. North America is kind of fully built out, right? They only added 515 stores in North America. And North America, their stores generate much more revenues and profitability than international. The international stores tend to be more kiosk places. People don't hang out there. Where here that, this is how what they try to do. But again, the goal of modeling is to break it down. The further we break it down, the more accurate our model becomes. And it's important to also, understand same-store sales, right? What is the important metric? So the company, if you were to look at it, they fired the CEO. Well, the reason why they fired the CEO is same-store sales were negative. Again, the goal of our model is to tell a story. We can understand why the CEO got fired, right? It went from positive same-store sales to now negative same-store sales. And internationally, their same-store sales are much worse than they are in the US because there's something called Luckin, which is this fast-growing China coffee store that's displacing Starbucks, and Starbucks had a big business in China, right? So this is all relevant information that we can communicate, in our model, and it's very helpful. Again, the issue that when I teach this in the classes, my students, struggle with this of funds flow. And this is all great information if you are interviewing, right? We need to reorganize the funds flow statement so that we can interpret it as finance professionals, not accountants. How efficient is the company at converting net income into cash flow? How capital intensive is the business? is there excess cash flow? If there is excess cash flow, how is it being spent? And if there's a deficiency, how is it being financed? Right? And so it shows why is this such an important statement. It shows the cash flow characteristics of the company, the working capital intensity of the business, their ability to convert net income into cash flow, and it allows us as finance professionals to convert book earnings into cash flow. So we organize it into three parts: cash flow from operations, capital spending, and how is a deficiency or excess either being spent or financed. Right? And so if there's a deficit, we want to know how is this deficit being financed, and if there is a surplus, how is it being spent? And there's really four buckets if there's a surplus. The change in debt, did they pay down debt? Did they repurchase stock? Did they pay a dividend? And did they spend it on acquisitions, right? And importantly, again, the net change in cash is the sum of cash flow from operations less capital spending and finance activities. This net change in cash on your spreadsheet should match what the company has on their, on their funds flow statement. So I do have one more example. Here is Starbucks, right? Same company we just talked about. And this just shows you the insanity of this thing that they call something, I mean, you have no idea what the hell's going on with this, right? You look at this and your head spins. So our goal is to convert this into something that we can use as finance professionals. So we start with net income, right? This comes from the income statement. Depreciation and amortization. We show deferred income taxes. All this other stuff, like who cares? Income earned from equity method investees, like that's baloney, right? All this stuff is just, pure accounting nonsense. So we sum this other stuff up, and it sums to minus 42. Who cares, right? I actually showed this one line, non-cash lease costs. You could argue because it was a big number, you can stick this in other, right? And then importantly, though, see how the accountants list all these changes, and this is each change in the different net working capital accounts. What I like to do is sum this up and show it as a change in net working capital, right? This is much more informative than looking at minuses and pluses. Your head's going to spin. So now we have net cash from operating activities here, right? This number here should match your cash flow from operations. Then we want to see how much capital was required to generate this level of cash flow. This is called additions to property, plants, and this is capital spending, minus 2.3 billion. We subtract this from this, and here we have a excess cash flow. The next question is, how did they spend, right, this excess cash flow? Well, there's a bunch of debt items here. They actually, if we sum all these debt items, it comes to change in debt plus 349. Then they did a bunch of stock activity. Proceeds from issuance of common stock, repurchases of common stock, and minimum tax withholdings on share-based awards. We sum these up, share repurchases minus 906, okay? And here is as I explained last week, a lot of companies that are cash generative, the treasurer function or the CFO is like, I don't want this money sitting in a checking account earning zero. They invest it in short-term treasury securities that mature, so they're constantly reinvesting these funds. This is all this activity here. Purchase of investments, sale of investments, maturities and calls of investments. We sum this up here, and many times it'll be close to zero. Here it's 9 million, right? This has nothing to do with the operations of the company. But the accountants make them show purchases and sales. It's complete nonsense. But we need to understand it, and importantly, right, this net change, right, here, if we don't include this activity here, we're not going to get to the 733 here, okay? And the last piece, anything that we didn't account for, we stick in other, right? effective exchange rates, and anything that isn't in these four buckets, we stick in another, who cares? And now this is what our cash flow statement looks like after we've reorganized it, right? Net income, right? Depreciation, stock-based compensation, non-lease costs, deferred taxes, other, change in working capital, $6 billion over 9. Remember, it equals what they had. Capital spending, excess cash flow. Now we can say, oh, now I understand this company. Well, Starbucks is a brilliant, business model. It only takes $2.3 billion to generate $6 billion, and this year $9 billion of right? Now, this is not a capital-intensive business, and actually doesn't really consume that much working capital, right? The founder, Howard Schultz, is a brilliant business guy. This is an amazing business, right? So this company, we can see that it's not that capital-intensive or working capital-intensive based on her analysis. So it generated in 2023 $3.7 billion in cash in excess cash flow. How did they spend it? Oh, they paid a dividend. Oh, they repurchased stock, right? This 733 here, right, equals exactly what the company actually, showed on theirs. But this organizes the information in a manner that allows us as finance professionals to actually interpret it, right? The other thing that I looked at, your head's going to spin, but it's hard, especially for people who haven't done this before or don't have accounting degrees, to understand how to take that gobbledygook and to put it in a manner you actually can understand the business. And this is what, finance is all about, is interpreting financial statements. So the balance sheet is easy, right? We just take the historic balance sheet and convert it into, into something that, a historic balance sheet. And let me just, And just on the balance sheet, I like to keep the balance sheet simple and not get overly complex. Important, we have, cash and equivalents, receivables, inventories, other current assets, property, plants, and equipment. You can group these together into other assets, it's fine. Total assets, remember, total assets equal shareholders' equity plus liabilities, right? Current liabilities, right? Important to show debt as a separate line item if they're short-term debt, right? We care about net working capital. Long-term debt, right? Critical in terms of when we're getting to the enterprise value and then backing out debt to arrive at the equity value. I stick all other liabilities and long-term into other. This number is accounting nonsense. Who cares? But we have to show it. In shareholders' equity, we, again, group all the various paid-in capital, retained earnings. It's, blah, blah, blah. Again, another useless measure, but we have to show it because this is what the accountants have, right? So this is, but important to see what historically here, and again, this number equals this number, at least on a historic basis. The fact that assets equal liabilities and shareholders' equity shows you've accounted for everything on the balance sheet. But again, the goal is to keep the balance sheet. If you were to look at an actual balance sheet, it's probably twice as long. The focus is on current assets, current liabilities, property, plant, and equipment, and long-term debt. All the other accounts really don't mean that much. All right, forecasting, this is what separates, really the people who were great at finance who are not so great at finance, right? So the market is extremely efficient at taking all the available information and distilling it into a stock price. What causes stock prices or values, even private companies in the venture capital world to change, to increase or decrease? It is what's going to happen in the future. And this is what our job as finance professionals is to understand the strategy, and the company's go-to-market, and then convert this into a model which we can use to value the company, right? Prediction is very difficult, especially if it's about the future, right? And so sustainability, competitive advantage is critical. The model is only good as the inputs. Why we care so much about strategy, right? If we're saying that the margins and revenue growth are going to be constant going forward, that's a big statement. We're saying that the company's competitive advantage is actually sustainable, right? And again, the model is only as good as the inputs. You can have a 4,000 line model with macros going here and there and going crazy. That model is useless if your inputs are wrong, right? Revenues, revenue growth, revenues, margins. That is what drives the accuracy of the model, not how many lines it has, et cetera, right? And once the model is completed, we need to continually challenge the assumptions against real-time information and trends, right? Forecasting accuracy decreases as the time horizon for the forecasting increases, right? And for most companies, you shouldn't go out more than 2 years, unless it's a high growth stock, because the value of that forecast past 2 years is going to decline materially, right? The future is very hard to forecast. Why is it that the weather, right? Next week's weather forecast for today, a week from today, like meaningless, right? You would never plan an outing a week from today based on the weather. The weather tomorrow, you can look at the weather forecast, that's probably pretty accurate, right? You're going to plan your day around, what to wear, raincoat, based on tomorrow's forecast. Same thing holds true in securities analysis, right? The farther you go out, the less relevant, right, the forecast is. So there's two types. There's a qualitative and a quantitative, and we need both, right? Here are common errors. I'm not going to I spend a lot of time in class. Why is it that most Wall Street forecasts are wrong? First is fear of being an outlier. It's scary if people think Meta's going to earn $3 and you're at $1, for the quarter. That's scary. And if you're wrong, you're going to look like an idiot. So most people, when they forecast, they try to get as close to consensus as possible, right? It's not a good way to make money long term, right? Relying on management for information, right? Management, especially for publicly traded companies, are a source of information. You need to, look at that, that information with a fair degree of skepticism. We all suffer from overconfidence and over-optimism, and we need to understand that, right? We all think we're smarter than we really are. It's human nature. Anchoring has to do with using the most recent quarter's growth rate or margins and carrying that forward. We anchor on the most recent data point, right? It's easy, but sometimes that could be wrong. And importantly, and this is human nature, we seek out confirming data, not disconfirming data. Once we make a decision or we make a forecast, the first thing we do is we try to make ourselves feel better about that forecast, right? We go out and try to find data we're seeking out data that makes us feel good about what we've just done, when we actually should be doing the opposite. We're trying to constantly challenge, is this right? And this is why most earnings per share forecasts are wrong. This is what Buffett said. So true. What the human being is best at doing is interpreting all new information so that their prior conclusions remain intact. Right? So true. We need to avoid this, right? I'm not going to go through this, right? The revenue forecast is by far the hardest and also the most important. It drives the rest of our model. And this is what core, those of you who are taking core, as they taught modeling, teach you, right? You start with the revenue forecast, and it populates the rest of the model for you, right? The more detailed, the more accurate the model. However, there's a law of diminishing returns. At a bare minimum, we should, if we can, have units in price and compare these against historic data, right? Industry data is the best place to start. You all are students, so I never expect this of you, but the people who are investing billions of dollars, they probably will have an algorithm that will take industry data and translate this into a revenue forecast. Some firms, have proprietary databases that they maintain, right? I have a friend in Boston who's a well-known fund manager who invests in the airline industry. He's got a supply-demand model for the airline industry that goes through each plane company, each airline, how much supply they're going to add for the next couple of years, and he has a lets him know what is going on with global supply demand, and this gives him an edge in terms of investing in the airline industry, right? So, really relevant for private equity, for all types of investing, but particularly early stage or even high growth companies. What is the TAM, the total addressable market? For high growth companies, critical analysis. Important to get this number right. It drives the rest of the model. Once the TAM is defined, you're going to estimate the market share penetration of the company. Where most venture capital and private equity firms this is where they spend their time on. What is the TAM for this company? They could give a rat's ass about the cost of capital. Who cares, right? This is what matters. How big is the TAM? And if we look at venture capital, right, the bigger the TAM, the more excited the company is going to get and the more willing they're going to fund the company. So the TAM is going to drives the model. Most mistakes in venture capital and private equity are made in not getting the TAM correct. They either think the TAM is bigger than it is, or they think the TAM is small and ends up getting much bigger. If we go back to Google when they went public, most people who did not invest in the stock did not appreciate how big the TAM was for internet-based search and search revenues. They got it completely wrong, right? And they also got the fact wrong that if we look at Google as a benefit of hindsight, Google had a growing market, growing market share, right? This is why the stock was so gigantic, right? Most firms, again, spend their time on getting the TAM correct. If we look at Peloton, why was everyone wrong about Peloton? The TAM, as they defined it, was way too big, right? And and this was the problem. The better the competitive advantage, the higher the market share, and the market share growth will be. Back in 2012, Benchmark Capital invested in Uber, right? They looked at Uber, its approach to the market. Wow, this is going to make taking a ride way easier. They probably looked at the global market of taxi cabs, and they assumed that Uber would probably take a 20% share in 10 years. This was the foundation of their revenue model. They assumed some costs, broke it down to their DCF, and they got an enormous number when they did their DCF, and they said, "Buy." It was an enormous stock for them, or the venture capital investment. By breaking down revenues into units and price, we can easily determine which is more important. The valuation is very sensitive to unit growth, right? So we want to, in a perfect world, see companies growing units versus price, right? Again, a good model tells the story. What are the drivers of revenue growth? And we're always comparing this against assumptions and industry trends. Gross margin, like a great interview question, right? Gross margin is an important driver of profitability and valuation. A stable to rising gross margin is rewarded a higher multiple than one that is declining, right? Gross margin really reflects the company's competitive advantage, the price that they're getting for the good or service they're selling against the cost to produce that good or service, right? Companies that have high gross margins, software companies, right? There's a high IP attached to that company. Companies that have low gross margin, auto manufacturer, coal companies, aluminum companies, right? These, the value add tends to be less. But we are looking, and so we want to see what is going on with gross margin, right? If we have a company with a stable to rising gross margin, that means their competitive advantage is probably increasing. So we want to show it on every model. Again, it reflects price and cost. In a company, if their costs are going up and they're not able to pass those costs on, that means their competitive advantage is probably not as strong as we thought. And as a result, their gross margin will decline. Operating expenses, right? This tends to be easy. SG&A, we can forecast individually or in total. You can use it as a percentage. Not that hard to forecast. Interestingly, selling expenses, right? And this is, especially a lot of new companies. Few of example would be Airbnb. Their selling expenses aren't that high. Airbnb is a verb. Same thing with Uber, right? Their selling expenses aren't that high. because Uber is a verb. And so we look at selling expenses. Other companies need to spend a fortune to basically get their good or service in the hands of others. And so this is a variable that we really care about. But again, not that hard to forecast. But importantly, what we see over time is if a company is growing revenues, there should be some operating margin expansion associated with growing revenues, right? The company is leveraging its SG&A base, right? So if you have revenues growing and you have growing margin expand. Again, we always, if we can, show EBITDA margin. We can either get that from the income statement or from the cash flow statement. Interest expense, I honestly don't spend that much time on this. If debt levels are going to be fairly constant, my shortcut is I take the most recent quarter and I multiply it by 4. Interest expense does not really change that much. The only time you would really focus on this is if a company was dramatically paying down debt, or it's an LBO and you're doing your LBO model and you're paying down debt aggressively, then yes, you're going to spend a lot of time. Most companies will give you interest expense. Income tax rate, I should have mentioned. So on gross margin, what I like to do is I actually type in gross margin on my model, right? So if I'm forecasting Meta's gross margin for 2026, I'll say 81.5 is what I think it's going to be. And I can substantiate this versus its history. And then I multiply that 0.815% times my revenue forecast, and this will give me gross profit. And then I subtract revenues less my gross profit forecast, and I will get cost of goods sold. The reason why it's better to do this is if you hard code cost of goods sold and your revenue changes and you don't adjust your cost of goods sold, what's going to happen? You're going to get a funky gross margin percentage. So what I like to do is hard code gross margin, and this way, as you are tinkering with your revenue forecast, it's changing your absolute level of gross profit dollars and cost of goods sold. On the SG&A side, and this is where reasonableness comes in, right? If operating margin was between 15 and 15.5% the last 4 years, and you're saying it's going to be 18% and you're keeping gross margin constant, chances are you're not using enough SG&A when you're forecasting. Income tax rate, most companies will give this to you, but we can look at the effective income tax rate over time, which is defined as income taxes divided by pre-tax income. There are quarterly fluctuations, but again, what I like to use is like 2023 is probably a good proxy for 2024, and 2024 is a good proxy for 2025. And again, what I like to do is type in like 0.23 is my forecast for Meta's income tax expense for 2026. So I type in 0.23, my income tax expense, that cell is going to be pre-tax income times income tax expense, and that is times income tax rate, that is my income tax expense. And then as I play with my model, I don't have to worry about typing in the income tax expense. My model essentially adjusts it for me. And so I see a lot of mistakes in my students' models where they hard-coded, I think income tax expense is going to be $24 billion, and they make a couple of assumptions. Now the tax rate goes from 23% to 40%. They didn't, it doesn't adjust as they're making adjustments to their model. Their share count, this is fully diluted. Remember, only use fully diluted shares outstanding. There's options issuance, share-based compensation, share repurchase trends. However, if you look at most companies, share-based typically does not change that much. Most companies manage their share bases to be flat over time. However, some companies, if they're aggressively repurchasing stock, you need to reflect that in the share base going down. All right, funds flow, that's the income statement. Most of you will nail that. We start with net income from the income statement. And then we forecast depreciation. It's a function of prior year's depreciation and the level of capital spending. So if capital spending is ramping, you need to also ramp depreciation expense. I'm going to get to working capital in a second. Capital spending, prior year's trends and management forecast, right? Many times they will give you what they expect capital spending to be this year. If you look at a lot of AI-based companies like Meta and Microsoft, CapEx has been going up. Most companies' capital spending doesn't really change that much. So if we subtract cash flow from operations less capital spending, we are going to get, most companies will have excess cash flow. And then dividend, share repurchase, debt pay down, this will be a function of management guidance. As a rule, the last piece we're going to talk about is acquisitions. We never forecast acquisitions. And I'm going to give an example. Dividends, we usually just use last year's level. Share repurchases, again, use last year's level. And I typically do not have debt being paid down. I keep it at zero. This would be different if the company just came out of being spun off or, is a candidate for an LBO. But in general, I keep debt paid down constant. Now, working capital, how do we arrive at that? Let us look at Meta for 2025. So just to show you the forecast. All right, so how did I forecast revenues? Well, I took what I think family daily active people are going to be units. They're going to be more effective at their advertising, so their revenue per daily active user is going to go up. We multiply this times this. We get 168 billion. I just screwed this a little bit. So my revenues are 170 billion. I targeted a gross margin of 81%, right? And then my gross profit is this 81% times this, and I get this 138. And then this is a function of this less this. So if I'm going to mess with this, this is automatically going to change. Or if I decide their revenue per daily active user is going to go up, this automatically changes. So I think this is a forecast. You can criticize me. They spent a fortune on R&D. I think it's going to decline. I could be wrong. Marketing and sales should go up. Again, G&A, look at how the company's, I think he's going to cut, but I could be wrong. So I have an aggressive forecast for 2025, but it's a forecast. It's my forecast. Your forecast is as good as anyone else's. And then I add, to get EBITD, I add operating income against my depreciation and amortization. Interest and other, I probably spent 10 seconds thinking about this. Maybe it's 600, maybe it'll go down. Pre-tax income, here's what I think their tax rate's going to do. This year it looks a little bit lower, so 18%. I multiply this times this to get 13,653. And then to get earnings per share, we divide this. This company issues a lot of stock to employees. I think it's going to go up. We get 23.65. Remember, we have our growth rates underneath. We don't put our growth rates up here because it distorts margin trends. So how do I forecast the funds flow? We start with net income, right? This comes from my income statement. They are spending a lot of money on CapEx, right? CapEx went from 27 billion to 38 billion. So I expect depreciation and amortization to increase. I usually keep stock-based comp flat with the prior year. Importantly, I never forecast deferred taxes and other. I just keep it there. Working capital, where did this number come from? Well, it comes from our balance sheet, okay? And so it really is our working capital forecast. So here's my accounts receivable should increase, prepaid expenses and others should increase, as are accounts payable and accrued liabilities. Remember, net working capital is accounts receivable plus inventories less accounts payable and accrued liabilities. Cash and equivalents and marketable securities are not working capital, right? And so we do not have these in any part of our working capital balance. And if this company had debt, right, debt also was not a part of working capital. So how do we arrive at net working capital? So we take receivables plus other assets, less accounts payable and accrued expenses, and this is what working capital actually is. Importantly, it is the change in working capital, H85 less I85, is the change in net working capital, and this is what gets reflected up here. Okay, this comes from our balance sheet forecast, okay? And I basically don't have it doing too much, okay? This comes from so this is how the balance sheet and the cash flow statement are integrated, right? Our balance sheet forecast feeds our funds flow forecast. And this is how the two are integrated, okay? So now we've got cash flow from operations of $92 billion. We subtract capital spending of $38 billion, and we get $54 billion, which is a big number like it is this year, right? Now the question is, where are they going to spend the money? So again, this is, and I'll get to this from about, so did I have debt going down? No, dividends of they initiated a dividend last year, so I kept the dividend fairly constant. And I think they're going to do $15 billion in share repurchases. So net change in cash of $34 billion. And we're going to get to this when we do our valuation analysis. It is critical when we are forecasting the balance sheet that we incorporate any change in cash into our cash and equivalents. Because remember, cash and equivalents is part of what? Net debt. Net debt drives the enterprise value of the company. So if we have cash increasing, right, this basically we're going to capture this in the enterprise value and importantly the equity value of the company. Because if net debt is declining or net debt is becoming more negative as cash increases, right, the equity is going to be worth more. It's critical that we capture what is going on here in the cash in our cash balance, because it's going to influence the amount that the equity is worth when we actually get to that. The other thing I should have said is that if we have debt being paid down here, it's reflected in debt right down here. Now I have, down here in terms of debt. Now I should have carried that forward, but debt right here of $26 billion, I don't have it changing at all, right? If I had debt being paid down up here, right, I would have debt declining going forward, right? But the importance is we are integrating the funds flow statement into our cash flow statement, and their cash flow statement into the balance sheet. If we have debt being paid down here, we should have debt declining in our balance sheet. If we have cash increasing, our cash account should increase by the amount here, right? If we had a big debt, if this was, call it 80 billion right here, then we would probably have shares outstanding going down as opposed to being fairly flat. But again, the importance here is that the income statement flows to the income statement is linked to the cash flow statement. It's the first line item, right? And then we make adjustments to reflect what we expect to happen to the change in the cash account. A number of you came up to me when you saw me around Questrom last week and said, wait, I'm taking core. I don't understand the cash flow statement and how it relates to a DCF, which we went over. The DCF and the cash flow statement are two entirely different things, right? We use the DCF to value a company, what the cash flow statement represents is a reconciliation of the change in the cash account for the year, right? Your DCF does not show, right, dividends, issuance of equity, acquisitions, or change in debt. There are components that are the same, right? There is capital spending, is kind of the same thing, right? Capital spending and working capital directly go into the DCF from our cash flow statement, right? So there are some similarities, but there are also some important differences. So the DCF and the funds flow statement are two entirely different things, and it's important to know that. So any questions before I go on? I usually take 2 classes and I'm doing this in an hour. Any questions going? Okay. Right, so again, change in working capital is a function of your working capital projection from the balance sheet forecast. We use prior year's capital spending to help, and also management forecast with capital spending. Dividend share repurchases, debt pay down, we can use management guidance or prior years. As a rule, we don't forecast acquisitions, and the change in cash is reflected in our valuation, right? Important that because cash influences net debt, right? Critical that either the cash surplus or deficit is captured if there is one. Cash and debt are important balance sheet categories that are used in valuation. If debt or cash is changing, this needs to be captured in the balance sheet forecast. It ties directly into the funds flow forecast, right? The further you model the company out, the more important it is to capture changes in the funds flow on the balance sheet, right? It's a critical component when valuing high growth companies. And so if we, again, go into the venture capital world, if you have a company and you are valuing it as a VC investor, right, and the company is cash flow negative the first 4 or 5 years, and there's either equity financing or debt financing, you need to incorporate that into your balance sheet forecast, right? Because it's going to have a huge influence on what the company is worth in year 5 or year 6. So again, when we model companies, we model the balance sheet, funds flow, and the income statement. They're all interrelated, and we need all 3 to actually come up with a valuation summary that makes sense, right? The cash forecast should come from the funds flow net change in cash plus last year's cash. It is not a formula based on historical averages. So many times in the classes that I teach, they will take do some 5-year regression of the cash of what happened in cash and forecast it going forward. No, right? We take last year's cash plus our projected change in cash from our funds flow is next year's cash. Debt forecast should come from the net change in debt projected in the funds flow. If none is projected, debt does not change. Unless the company is highly levered, we probably should keep the debt constant and not have any change projected in the funds flow. And this goes to, the Modigliani and Miller theorem. Hopefully those of you who've had core, right? Critical thing that we'll talk about in the future, right? How much debt or equity we have has no bearing on how the company is valued. Most companies try to manage their share base to be constant and offset options dilution, share repurchase assumption. The funds flow should reflect this. If the company is aggressive in repurchasing stock, their shares outstanding should be declining. And so in Meta's case, we always keep the change in marketable securities constant, and basically don't grow it at all. And our change in working capital forecast on the funds flow should come from the balance sheet forecast, right? So we first model our expectations for working capital, receivables, inventory, accrued expenses, and payables. We model that on the balance sheet, and then the net change in working capital is what gets reflected in our funds flow statement. And importantly, when we are modeling the current assets, current liabilities, most companies, as they grow revenues, they are growing receivables and they're growing inventories, offset by a growth in payables, right? And so most companies are working capital intensive. They need working capital to grow. So as you are growing, revenues in the income statement, you probably should be growing receivables and inventories as well. Balance sheet forecast. Critical components are cash, total debt, and net working capital. Again, the net working capital forecast is important components of the cash flow forecast. Total debt and cash are important variables in valuation. We net the two together to arrive at net debt. With property, plant, and equipment, we can always, which I think is our next, is return on invested capital. And we focus on what is material when we are forecasting. So these things I've talked about here are all critical. So cash, last year's cash balance plus this year's projected change. Working capital, accounts receivable, inventories, accounts payable, accrued liabilities, a function of revenue growth, percentage of revenues with some assumptions regarding working capital efficiency over time. PP&E, if the company is growing, chances are you need to grow PP&E in line with revenue growth. So if you were to model Tesla, right, chances are if you think they're going to continue to sell more EVs, you got to grow PP&E in line with it, right? And also a function of the capital intensity of the business. I always keep other assets constant. Long-term debt, last year's long-term debt plus the projected change. So if you think that the company is going to pay down debt, then your funds flow should reflect that debt is negative, and that negative change is going to show long-term debt declining. So this is me, and most professors here would shudder at this. I actually never have my balance sheet in balance. I honestly don't care. And my thought is that if I don't use other liabilities and shareholders' equity to value the company, why am I going to bother forecasting them? That's like, I know, heresy and questrum, but that's just me. If you want to waste some mental energy making your balance sheet balance, go for it. But other liabilities and we forecast all this stuff to allow us to value a company, right? We are dealing with forecasting. I focus my time and energy in forecasting what's going to drive my model and the company's valuation. If other liabilities and shareholders' equity, which are purely accounting numbers, have no bearing on how I value the company, I'm not going to waste any mental energy on it. But if you want to do it to make your professors happy, go for it, right? Who cares? It's not relevant. And also for valuation work or return on invested capital. All three financial statements are linked and interconnected. And the key things to remember, everything starts with the revenue forecast. Revenues are the hardest to forecast and also the most important. A reasonableness test of your forecast, which we'll get to next week, is your return on invested capital calculation. And I probably shouldn't have talked any more about this. And this is basically forecasting in 1 hour, and I think we're done. Any questions on what I just discussed? That was really fast. The best way to learn how to model is by doing it, okay? The more you do it, the more you get comfortable with it. I could lecture up here for the next 10 weeks, and you still wouldn't know how to model until you physically did it, okay? So I noticed I need to up my meta forecast, had a slight error in it. I'm going to upload it after I make the change. I even will upload the Starbucks forecast or my Starbucks model, so you at least have a place to start. My students have found that having a template or an Excel file to start makes their life easier as opposed to starting from scratch, right? And so it's like a template. And I guess the last point is, those of you who worked last summer or are going to be working this summer, each firm has their own idiosyncrasies with modeling. And they'll look at the way I model and say, that person's an idiot or a loser. Who taught you this, right? And I'd say the same thing about the model that you show me. It's like, what is this stuff, right? We all have, those of us who, invest for a living, we all have our, idiosyncrasies in terms of what we look at. But the importance is that, all three of the financial statements are linked, critical, right? And the income statement fund leads into the funds flow, and the funds flow and the balance sheet are interconnected. So, and we always put our metrics at the top of our model, and the metrics drive the revenue build. After that, whether they're linked, whether you have different tabs or it's all on one statement, who cares? But if you understand the basics of modeling, right, and the importance of modeling out the balance sheet based on your income statement and funds flow forecast, you're way ahead of the game, especially in interviewing. Okay, I guess what next week is return on invested capital? Great, okay. Oh, cost of, as you can tell, I hate cost of capital. All right, cost of capital is next week. I will have some fun. Oh, actually, let me do